let's say 100 acres of land right next to a transformer, and you can get interconnection on 10 gigawatts. That will be a gold mine. And people have done that and bought it at X and sold it at 40X after they actually get power to the site.
Welcome back to All-Star Allocator. Today, I'm joined by Marcus Solomon from Makena Capital. Makena Capital is an institutional investor with over $20 billion asset under management. They have a broad mandate from real estate to private equity to public markets. We talk about data center investment, how managers get selected, niche strategies, and what it takes to build a track record. This one is full of insights, and let's dive in. Hey, Marcus, really glad to have you on. Before we dive right in, I like to start with some context. So can you share a little bit more about Makena Capital?
Of course. Thank you for having me on, Austin. Makena Capital is unique in the ecosystem. So we spun out from Stanford around 2005. And since then, we've grown. So our main products is an endowment style fund. We call it the MEP, which is roughly $11.5 billion at this point in time. But we have a number of sidecar vehicles that invest across the private space. So we have venture capital. We sit on Sand Hill Road, so a lot of people know us for that. We also have a buyout bucket and also real estate as well.
What type of opportunities are you looking at?
In the ecosystem, we look at everything. So we have things from SpaceX in our portfolio to other venture companies. So we're very well known in the venture space just from where we sit. So like I said, we sit on Sand Hill Road right across from the famous Rosewood. So a lot of people know us for that and also our connection to Stanford. But we also connect with managers outside that space as well as investments. So you can think of real estate. We've invested in top real estate across the world and country. And then also in the public markets, we're very active. We even run our own internal book on that side of things that I was a part of in a REIT portfolio that was $150 million.
Nice, great. And how did you get here? I know that you started with Morgan Stanley and you were doing fast-paced trading, and right now you're doing steady real assets. How does that journey happen?
Yeah, some people would say it's a more unconventional path. Everybody questions me when they hear I went from trading after school to then I flipped into private equity real estate. But to be honest, it was just my love for investing. So like taking a step back in college, just played sports. During that period of time, I was trying to figure out like what is in finance. So my first internship was actually a back office role in the internal audit. At Morgan Stanley, loved Morgan Stanley, didn't love the role per se. So I decided to take a bet on myself and quit basketball and then just went into the world. Had an internship at Goldman in the family office and then got lucky and ended up in trading. The trading role was focused on consumer discretionary as well as technology trading, mainly on the short side. So think of Melvin Capital. Everybody likes to talk about GameStop. That was one of our biggest trades on the desk at the time. We were building up that book.
You were early on that.
Yeah, very early, very early. It ended up blowing up, but I wasn't there at that point in time. But then at that juncture, I realized that maybe I want to do something that I can take with me long term, and real estate was that thing. So in 2020, right before the pandemic hit, I moved over to the West Coast, internal to Morgan Stanley, and sat at MSREI, which is famous in the real estate world. Did that for roughly 2.5 to 3 years. And decided to jump over to Makena after they recruited me. What drew me to Makena was the ability to invest in the public markets as well as the private markets. So combining where I started to like where I am now, aka private and public investing and doing co-investments, direct investing, as well as being able to invest in some managers in our book.
Sounds interesting. So you have a very broad mandate. You can really invest in a lot of things. So how do you organize your day? Like what is your day-to-day work look like? Start when and what do you have to do during the day?
Yeah, our day is very dynamic. Depends on the week, the month, the day, really. But just to think about it, our day is really comprised of focusing first on our portfolio and our clients. So in terms of investments, if you think about it, we have direct investments, or co-investments, as some people like to say. Then we have fund managers. Right now, it's a 50-50 split in our book, or in terms of execution. And that's how we're going to think about on a go-forward basis. So a lot of people shifting more to direct investing versus historically it was this fund investing in our book. So we'll spend time going through our current positions as well as prospective investments as last managers. And then the other side of the job day to day is also we have clients on the other side. So it's not your typical endowment. We're an investment manager. We have clients on the other side. Those are endowments, families, foundations. We'll also spend time with them. So we also talk to clients and give them an update on like what's going on across our book and landscape.
Are those updates more scheduled around every quarter or they happens on demand?
Yeah, so we have quarterly updates that our CIO will give, but we also have other accounts that my team will give quarterly updates on as well. You're going to have sometimes clients will come to you, for example, when everything was going on in the April timeframe. A lot of clients came to us asking us what's going on, or even when you hear something big happen in real estate or a big headline come out about data centers, they'll come straight to our team and ask us what's going on and our opinion about it. Usually we'll have an opinion on it. We're reading the same headlines, but also we're getting a lot of information in from our properties, or investments across the country and the world.
That makes sense. Yeah. So when some new strategy or some new funds come to you for investment, what are the two key questions that you must ask?
Yeah. So if we're thinking about a manager versus a fund versus a co-investment or direct investment, that's the big distinction of like the questions I'll ask. So I'll start with funds. Is what is your differentiating factor is the number one thing for us that we're trying to figure out. So are you an operator versus an allocator is a big thing. So in historical world, there's a lot of allocators in the real estate space or even in the industrial space. For us, we're mainly going to be focused now on operators. So someone that can actually add something to the property or to the investment on a day-to-day basis. First allocator, we feel like we're doing that job. So we'll allocate the capital out to different sectors or different property types. So that's one of the number one things that we try to distinguish beforehand, and when we go into the meeting. And then it's what are the actual expertise that you're bringing with that. So let's say specific sector. Let's use data centers. Data centers is a big thing going on right now. A lot of people will not even understand like the power behind it. And that's an automatic disqualifier for you, just because if you know data centers, it's not just about having the land. It's actually about having the power, understanding what the utilities are doing and having a relationship with them. So that's something of like giving a direct in terms of like funds / co-investments example. And then if you're thinking about an investment, we'll start diving pretty deep into like the actual details of the model and understanding like how are you going to add value here and what does it look like on an exit. Some assumptions people make, it's an automatic disqualifier for us. We know the space very well across all investments because we probably see more than even someone that sits in a direct seat, because we have the funds as well as the co-investments in our book. So if assumptions wildly off from like what we expect it to be, we'll dive into that. And if they give a good answer of like the why behind it, maybe we'll continue. But that can be a killer of a deal off the bat.
How do you verify your assumptions? Because sometimes as things progress, assumptions will change. Like how do you find the signal out of the noise?
Yeah. So there's a couple of ways that we do that. So you have your typical, you look at comps in the market, public and private markets. Everybody does that. There's no difference. And any good manager will already have that in their deck, either their fund deck or their co-investment deck. The thing for us, though, and a lot of people, I don't think appreciate that this as much, is we also have a wide range of materials that come into us that we save down and we actually are building out databases around. So I use data centers as one of the key points. Data centers don't have like a clear market where you can go on CoStar or any type of like internet source or from one of the brokerage sites. So we'll save everything down. We'll start building out our own internal model around it. That way we can say, oh, you're projecting a 6% cap rate or 6%. We can go to EBITDA multiples as well. And then we realize like if you actually see trades across the market, it's really going to be in the 7% range, just to give like a wide range. And then we're start questioning there of like the why behind you believe in this assumption. And then also for us, it's about our actual portfolio in the ground and what we're able to execute on. Not everything hits the tape, I like to say. So for us, it's like, all right, we start looking at that and we're like, that's not actually what happens in those markets. And this is actually what occurs. And the last is like using brokers. Just like everybody else, we have our brokerage relationships that are pretty strong.
Sounds great. So data center is definitely very hot. There's also a lot of risk. And sometimes people say it's the telecom time that you are risking overbuilding. Maybe, it's too concentrated. Maybe the infrastructure only lasted for certain years. Look at the prior generation of data centers, they are not suitable for today's AI demand, and they have to do a lot of retrofit. So there's a lot of risks as well with even as hot as a data center investment. What risks are you comfortable taking, and what risks are you trying to avoid?
Great question. Data center land is very dynamic at this point in time. For us, the way we think about the framework is we invest in development, which is risky. But with that being said, it's in the tier one markets. So think of Northern Virginia is like one of the hottest markets in the world, just because of its location and its strategicness for like the US government. And another like top market that a lot of people know is Silicon Valley, aka like Santa Clara, et cetera. So we'll focus on those markets for development and the partner on the other side. What we look at per se is one, where are you in the power queue? It's the number one thing to think about. Because if you are, for example, getting power in 2035, hyperscalers as well as any user on the other side is not going to come to you. They're going to be like, we're not worried about that right this second. We'll come to you and maybe in 5 years. First, if you're getting power online in 2027, that is perfect. That's like you hit the sweet spot. And we will only execute with a partner if they have clear sight into a hyperscaler on the other side. So we focus on the credit, and it's a 15-year lease, pretty much on the minimum at these days, and also like the rent bumps that also occur there. These are underwriting to like north of 20% IRRs at this point, so it's very attractive to us. And that's one way we play it. Another way we play it, which is a little bit more risky on the other end of the spectrum, and you can get more risky into development, is going into like powered land, which is a big piece of this these days. On the powered land side, we do this more on like a portfolio approach. So across the country is how we think about it. So this goes into tier one as well as tier two markets. And on this approach, they actually acquire the land using something that's called an option contract. So you have an option contract that you actually go to, let's say mom and pop that owns 100 acres of land. It's right next to a transformer or power lines. And you can get interconnection on 10 gigawatts, for example. That will be a gold mine. And people have done that and bought it at X and sold it at 40X after they actually get power to the site. So it's different ways of playing it. We play both ends of the spectrum. Both have been successful for us so far.
That's fascinating. We, as a fund investing in Ohio, data center is actually one of our catalysts as well.
Yeah. Think about like the utilities, and like it does take a lot of capital to actually do this. It's very capital intensive. So if you think about it, the players that are on the other side, we don't have $100 billion to put up for a single project, or even $1 billion that we bet on a single project. But if you think about it, the bigger pension funds or sovereign wealth funds around the world do. So our government has a lot of people investing into our infrastructure right now to build this out, just because it's an arms race, as people have heard across headlines, et cetera. You have to put up, like you're talking about take or pay contracts, you have to put up a substantial amount of deposit down to these utilities now. Otherwise, they will not put you in the queue. So there's not as much speculative powered land in the pipeline anymore as there was maybe even a year ago, because the utilities understand a lot of these people, when they get to that point, they don't have the money there. So they want to make sure you already have the money and you're actually putting substantial dollars down. Talking about Ohio, it's actually a very interesting market for us. and we've taken a look at it and are have like investments in the ground there as well. It's probably one of the top markets in terms of how everybody's thinking about it, especially because, as you know, a lot of manufacturing is going to occur there as well. So we even looked at multifamily there, and it's interesting. We'll see how it all plays out because it definitely has been red hot.
Yeah. Personally, I believe the manufacturing reshoring will actually happen and many places are stand to benefit. One of the hot places is Ohio because it does have existing infrastructure as well as a pretty supportive environment in terms of land, in terms of regulation. Yeah, let's switch gear a little bit. So when you are looking at investment opportunity, how much weight do you put on the asset versus how much weight do you put on the manager?
Yeah, no, great question. It depends on what property type or what type of investment we're talking about. So, for example, something that's like an industrial box, we're not going to put that much emphasis on the operator per se or the manager, just because you're just thinking about like the credit of the tenant, what market is it is in. It's simple dynamics. Versus if we're talking about, for example, going way out on the spectrum, we look at like battery storage as in Europe. With that, you're really looking at the operator and understanding if they can actually operate this from a day-to-day perspective and they understand energy and how everything is flowing. So it depends on the complexity of the actual investment. We do spend time in the model understanding the assumptions, but then we're going to put a lot of emphasis of, are you actually able to operate this on a day-to-day basis? Because even if the numbers work and you can't operate it, it does not matter. So we will meet with management teams, and even my boss sits on some of the top boards in our portfolio. So it all depends.
Because you look at this wide spectrum of assets, what's the feedback loop? Like, is there any actionable takeaway from one investment saying, you can tell this is a repeatable pattern, which you can be using the same methodology or learning to another investment, or they're very different. And every time you have to develop a deep expertise and learn on the go.
Yeah, it's a good question. It's a unique seat because there are things where we have to dive very deep versus repeatable. I think there's certain areas that we have focused on. So, for example, like senior housing, data centers that we've been talking about, multifamily, those are very repeatable for us. Even power infrastructure is now very repeatable. Versus there's like niche asset classes or niche property types that come to us that are, let's use like RV storage. For that, we would have to dive pretty deep on. We can use some other things and like draw parallels to it, but we want to make sure we really understand it. Even parts of hospitality. Hospitality is broken up into your ultra luxury, and then you have like luxury, you have economy. Every segment of that market is very different. So every time you do have to dive into either the market or the actual property type that you're talking about.
That makes sense. So in the tech world, I know that people don't mind the operators or the startup founders who come from an outside industry because sometimes they bring new perspectives, new ideas to disrupt the existing. I'm curious, in real estate or real assets, do you see similar things, or do you prefer a person that did this for 20 years and has been consistent?
Yeah, it's a great question. If you bring us a great deal and we're underwriting alongside of you and you're quote unquote like a new manager, we're gonna dive in with you. But if it's operationally intensive and you do need expertise, we're probably not going to end up backing you. So, for example, senior housing is a great one, very operationally intensive. It's not just like real estate at the end of the day. If you're just diving in and you're the one operating in day-to-day basis, we're probably not going to give you any capital or be partners with you. Versus if it's industrial, as I said before, you bring us a great deal, we're willing to do it. I think the thing about the senior housing, if you do have an operating partner that you can partner with that does have that expertise, then we're willing to dive in with you. We've seen that in some of our infrastructure plays where someone in the real estate space just finds a great deal in XYZ segment. We can use railroads. Earlier this year, we looked at something in the railroad space, And the manager came from the multifamily space. We're like, he doesn't have expertise there, but he brought in someone that was 40 years in the industry, and they're the actual operator day to day. So we spent a lot of time with that individual, understanding that, and then we'll also underwrite the deal alongside what I call like the private equity capital.
Great. Makes sense. Yeah. So for emerging managers and new managers that don't have a ton of track record, what advice would you give to help them start and scale their business?
For emerging managers and new managers, especially like in the real estate space, I think the number one thing is bringing deals to people so they can underwrite alongside of you. I think seeded funds are better than blind pool funds these days. So if you don't have a deal, it's going to be almost impossible if you don't have a track record behind you. The reason being, there's something everybody calls like the J curve. So we're paying you and paying you fees, and you don't actually have deals. Eats into our return, and the slippage is pretty meaningful at some points in time. So having a deal that you can talk through with somebody, and at least starting off with deals with them before you raise just a fund off the bat is probably like the best path forward at this point in time. And then once you develop a track record, word of mouth of if you print 30% IRRs for people, they'll come and they'll also spread it to other people in the industry. And I think that's just the best way of going about it from what I've seen.
Great. Well, it's not easy to deliver 30% these days, but some people may make it happen.
It doesn't have to be
I'm
30%, it could be 20%.
yeah. So a quick question. So for BTR space, do you currently look at it or SFR? And what's your take on those?
Yeah, built to rank space and SFR space, we've definitely taken a good look at them. We haven't made like substantial investments in either one of those segments, mainly because the cost of capital has come down in some of those segments. So we have a very high cost of capital relatively to other groups. So we're more in the 18% gross or 15% net space. So the higher teens. Some people are like, oh, that's easy to do. But with the quantum of capital that we actually need to deploy and over the period of time, it's not as easy as you would think in real estate. But for BTR and SFR, we think they're very interesting. The tailwinds, as we all know, reading headlines of people not being able to buy like single family housing is real. So a lot of people are having to rent more or make the choice of renting just because they want mobility across the country. So all the tailwinds are there for us. The other thing for us is like understanding like the regulatory risk. So the market is very market dependent on like where you choose. If you told me California or New York, it'd be an absolutely no for us in terms of investing there, just because the regulatory overhang can just eliminate any returns, even if you have a 20% IRR one day, they can flip the switch and it's a zero the next. So we're very focused on regulatory risk. So I think in certain states, we'll take a look at it. In others, it's automatically that'll be screening that out.
Yeah, that makes sense. And how important to you is that fund needs to manage the project or the property themselves versus outsource the property management?
Yeah, I think as everything, it's dynamic. We'd rather someone be an operator of the actual assets day to day and be close to the assets. The reason being is once you have skin in the game, you can understand and pull levers. Versus just having someone that's a third party that might not be aligned with you in terms of incentives. I think that's the biggest thing. If you do have a operator that you've outsourced, that has skin in the game, so has like 5% of the equity stack or even 1%, but has upside of like when they actually hit performance, they can take promote home or carry, then we're more willing to do that. So we really look at the incentives and your experience in the space as like an indicator of like if we're comfortable with moving forward.
Those are wonderful insights. Has any of your view changed since you joined McKenna, and what surprised you most?
Yeah. Some of my views have changed just because we cover a wide range, a wider range than what I was used to at Morgan Stanley, which were the big property types or what people call the core real estate types. So think office, think industrial, think multifamily, versus now going outside to like more niche spaces. I think the niche spaces are very interesting and like the growing segments of the markets. Even you talked about BTR and SFR. Technically, that's not in the multifamily space, and a lot of people only invest in multifamily buildings. So I think that dynamic has changed, is expanding like what I actually know in terms of investing in real estate. And then also the biggest thing for me and move was real assets. So think infrastructure and energy. Energy is extremely interesting, but there is a lot of risk there. So understanding like the contracts and other side of it, and even going into like Europe. Europe is very interesting of like how they deal with things with renewables, turning off coal plants, turning off even nuclear in some countries, has made it more interesting to like really understand those dynamics and how everything plays together.
Are those investments primarily be made by the US team? Or
Yeah, everything goes out of Sand Hill Road, aka like Menlo Park, for us. So we will spend time going overseas. So we all have teams that go on the ground in Asia. We'll have teams that go on the ground in Europe, but everything is invested outside of our Menlo Park office. So technically, we don't have any investment professionals on the ground, but we do have managers, operators that are on the ground there, and they do have teams in London, in Singapore, in whatever market we're investing in. We will not invest with someone that doesn't have boots on the ground in that specific market from a day-to-day perspective. But us as a team, we all sit it pretty much in California, and then we'll spend time in those markets doing our due diligence.
I do have a couple of questions as a lightning round. Are you ready for that?
Yes, I am.
Sounds good. So, what's the one thing that GP says that makes you instantly skeptical?
Fund size. If they're raising their fund size 2 to 3x, it's automatically skeptical, because then I think they're playing for fees.
And what financial decisions, either from your personal standpoint or or your past investments, that you regret not making sooner?
Yeah, it's a good question. I'm a big personal investor. I think for me, on like a personal level, is just being in the market. I think a lot of people are scared to get in for obvious reasons. No one wants to lose money, but I think at a young age, you should take that risk and invest over a long period of time. If it's just in ETFs, I think that is the main thing, and just getting your feet wet. Because once you get your feet wet and you do get burned 1 or 2 times, I think that's where you really learn versus waiting till you're 35, 40 years old. Not saying that's old, but at that point in time, you probably have kids or you have more responsibilities taking care of people. So you're even less likely to take risk.
Yep. Yep. And what is one kind of overrated financial advice that you hear all the time? I'll give you mine, which is 60% stock, 40% bonds.
Yeah,
That's actually not the most productive asset allocation in my opinion.
I completely agree with you on that side of things. I think that was the old days, and people haven't updated that. I think people have moved to like 70/30 is like what I've been hearing more, and a lot of allocators as well as investment shops do that. Even some people 80/20. That's a great one. I think what's the most um that's a good question. One that was funny for me during the pandemic is like doing options trading, just because I came from a desk that did a lot of options trading. I think people taking those bets, which is mainly most of the time 0 or 1, aka you make money or lose it all. I think that's very overrated in terms of advice to give to like our individual investor. I think people have hit home runs, but you're really just in that time doing sports betting, which I don't agree with.
Got it. Yeah. So, is there any a book or website or any resources that you would recommend to people who are listening?
I'm a big podcast person, and this might not be for um, everybody, but I love podcasts just talking about like founders. So, like the Founders podcast is a great one. Another great resource, and I look at pretty much every day, is just like reading the news. It's simple, but like the Wall Street Journal, I pretty much like read every day, just to get yourself acquainted with the market and have conversations like with friends about it, is like the main thing for me.
Great. Yeah. And what do you do outside work?
Yeah. Outside work, big sports guy. So college basketball season is probably my favorite time of the year. Just watching college basketball, even college football, it starts this weekend. I'm extremely excited for it. And then I played basketball growing up, so anything sports related, getting out, hiking, just being active.
Sounds great. And how can people find you?
Yeah, I think the best way to find me is LinkedIn. And if you message me, I'm pretty quick at responding. I have it on my phone day to day. And then from there, we can follow up via email. I always love to connect with people.
Wonderful. Thank you so much for your time. Really appreciate it, and the great insights on the tough questions.
Yeah, no, thank you, Austin, for inviting me on. It was good to see you.
Good to see you. That's a wrap for today's episode of All-Star Allocator. Big thanks to Marcus for sharing his perspective. If you enjoy the conversation, make sure you follow the show wherever you listen to a podcast. And if you're finding value, a quick rating or share goes really a long way. Thanks for tuning in, and we'll see you on the next one.